Welcome, everyone. We have I think, a very important and timely topic today. We're going to talk with Mr. Andrew Topping, our favorite real estate investor-focused accountant. And I think the big news of the day is the UHT, the Underused Housing Tax change. No idea what the hell it is, but we're going to find out. And you guys are going to get ahead of this thing, because I got to get ahead of this thing too, because, you know, we had 200 registrations here. And when that kind of stuff happens, I know it's front and center in everyone's mind. And what happens is everybody asks me. And if I say, I don't know, I feel like an idiot, right? It's my job to stay on top of this stuff. So I'm very happy. We all have, everybody seriously legit has to say thank you to Andrew, because, you know, as you know, it's tax time, and, you know, he's busy as hell, and he's carved out some time to be here with us for an hour or so. So let's be thankful and grateful. I know I am. And before we start, I just want to say something that's very important. In this crazy time that we're in right now in the real estate market, you know, a lot of people are kind of sitting on their hands, not knowing what to do. Interest rates are up, market's crazy, and that's totally normal. I mean, we're humans, and as human beings, confused minds always say no, and that's just natural programming. And there's nothing wrong with you if you're just sitting on your hands, but you know, there is a problem that if this lasts any longer and you're sitting on cash, you know, you're going to get the invisible tax called inflation eat your savings away. And there's nothing you, I, or Andrew can do about that. And that's real. And you're not going to know it's real until you figure it out. When your 100 grand doesn't buy you 100 grand worth of stuff anymore. If you've been to the grocery store, you know what I'm talking about. But when that starts hitting real assets again, when the cycle starts, you're going to feel it, and it's going to hurt, right? So they're really quickly, like 5 minutes or less, you know, what I've been coaching some people on is basically, it sums up to 3 things. We have to pivot. Even I've had to pivot. So if you really don't have a lot of cash to spend, doesn't mean you should sit on your hands. Really what you should be doing is repairing weak spots in your portfolio. You know, if you have a tenant that's paying $700 for the past 8 years, that kind of thing, you know, a unit that could use some renovation and increase the rents, anything you can do without spending a ton of money to increase the income, increase the value of your property, recycle tenants, get the rents up, get the expenses down while you can, that's going to be extremely valuable, especially if you have nothing better to do because you can't buy anyway. You might as well use your time wisely, okay? Number 2, refinance equity. Now, you might be thinking I'm crazy, I must have a mortgage broker license. I don't, but some people have a tremendous amount of equity. I know our equity's gone down a bit, maybe in the last year and a half or so, but it's gone up for 25 years. So you have equity if you own properties. There's nothing wrong with accessing it. I'm not saying sell the property and throw it in the garbage, but access it, because there are opportunities out there that are way below market value than we're used to. And you know, people are taking advantage of that. And the third thing is, if you know, you do have cash available, you know, and I'm wearing my salesman hat when I'm saying this to you, but you get those under market value opportunities. You know, I've got a few for myself in the past 6 months, and it's been fantastic. I haven't seen these kind of deals in, I'm measuring in years now, and it's been great. And just to show you other investors who are doing it too, I'll do a quick share, and then I'll give it to Andrew. What the hell is this one? So if anybody knows the Hamilton Mountain, this is a deal one of our investors grabbed, and very nice property. I think I just saw the seller on the call too, and I think he'd be proud. He did a great job kind of maintaining the property. It's a 2-unit property. Let me get to the floor plans here. Hello, there we go. I was just tripping out. There we are. I don't know what's happening. Okay, so that's the upper, and really quickly the lower had, you know, full 2-bedroom, bathroom, full kitchen, and it's a solid deal for this time. You know, and you know, the seller's going to reinvest his money into something that's much higher cash flow, like we talked about. But another investor is going to come in and, you know, pay less than what they're used to. I'm going to mute whoever that is. Whatever, sorry. So don't just sit on your hands is what my message to you is. There are ways you can improve yourself, improve your portfolio, and bonus, try and get better at something. You don't want to do nothing, that's fine too. I'm not judging you. It's a crazy time, but get better at something. One thing I'm doing that's tax related is getting better at bookkeeping because I suck. So on that note, I just wanted to put my 2 cents in there. I'll give it to Andrew. Again, say thank you to him for being here. And we're going to roll on with this. Take over, my friend.
Perfect. Okay, I'm just going to see if I can't share a screen here.
I'll make you a co-host really fast. Done. You're the boss now.
Perfect. There, so hope everybody can see that.
Yes, sir.
Perfect. Okay. So we're going to sort of quickly go over the main stuff with the underused housing tax. This was originally billed as a tax on non-Canadian residents and non-Canadian citizens. It ended up catching a whole lot more people than we expected. Nobody really paid attention to it, and I'm included in that boat. Nobody really looked at this until January of this year. So this legislation has been around since about June of 2022, so June of last year. But nobody really looked at it because, as I said, it was billed as it was going to be this tax on non-residents and non-Canadian citizens. So it was sort of expected that it wasn't going to impact a lot of the client bases of sort of strictly Canadian resident people firms. And so in January, it sort of came out that some of these rules were going to catch a lot more than we thought they were. And so now we're sort of dealing with the fallout of that on a very quick basis. So in any case, the underused housing tax, for anybody that's not familiar, and it sounds like everybody sort of signed up for this reason. So I'm going to assume that all of you have heard of it. It is a 1% tax on the value of vacant or underused residential housing in Canada. Okay, so key point there, residential. And it is intended to force people who own Canadian real estate to rent it, as opposed to potentially just storing your wealth in it and not actually using it for anything. Anybody that's on this call, or the likelihood that anybody on this call is going to be subject to the tax is very low, unless we have a lot of non-residents or a lot of non-Canadian permanent residents or non-Canadian citizens. I suspect that's probably not the case, but the catch is that you still have to file a return. So there's 2 parts to the underused housing tax. One is filing the return. The second is actually paying the tax. There's a lot of exemptions. So you probably won't have to pay the tax, but a lot of people on the call, if they own real estate and they're not reporting it personally, a lot of people are probably going to have to file the returns. Okay. As you'll see, the last point on this slide is the minimum. And the real key point here is the minimum late filing penalty if you're an individual is $5,000. If you're a corp, it's $10,000. And this is per return. Okay. So if you have 5 properties in a corporation and you don't file for any of them, it's $10,000 per form. So it's $50,000 for not filing those returns. Okay. So the 1% tax is not really the issue. It's the filing of the form. Okay. And the forms, as you'll see, I don't actually have a copy in this, but they're easy to find online. The forms are really simple. There's not a lot of information that's needed. And so they are pretty simple to fill out. You need, your name, property address. And then the hardest part is, what's the assessed value, which you can get from your property tax statement? What's your property tax roll? What's your property ID? And who the owners are. That's the hardest part of the form. Okay. But if you have to file, first step is determine whether you have to file. If you have to file, make sure you file. CRA, in their infinite wisdom, they made their filing deadline for these forms April 30th. So we're getting a lot of questions about them, but certainly my firm, and I've talked to a lot of other small accounting firm owners, and a lot of them don't have the resources or the capacity to actually prepare the returns for all of their clients. So by setting the deadline to April 30th, CRA has kind of made it difficult for accountants to help their clients because it's the same filing deadline as obviously personal tax. Okay, so make sure you know whether you need to file them. I'm going to go through the criteria, but if you need to file, make sure you file because the penalties are big. So an excluded owner is not required to file a return. Okay, if you're not an excluded owner, you have to file a return. But as I said, most of the people that are probably on this Zoom call probably will not have to pay the tax. Okay, so excluded owner, for the most part, anybody that's on this call, probably the excluded owner criteria that's going to fit, if one fits, is an individual who is a Canadian citizen or permanent resident. Okay, so high level, if you're a Canadian citizen and you're a permanent resident or a permanent resident and you own real estate, you're excluded unless you own it as a trustee of a trust or a partner in a partnership. Okay, so a trust is a very broad term in this sense. A trust can be a joint venture. A trust can be an actual family trust. A trust can be me holding a property in trust for my parents. Okay, so even a property that I'm not renting, maybe I own my parents' home, but I don't live in it. I have nothing to do with it. They pay all the bills and everything else, but I actually hold title. Because I'm not living in it, because I'm holding it for the benefit of someone who's not me, I would have to file a return in that case. Okay, so the number of people that are going to have to file is significant, but the number of people that are going to have to pay the tax, very, very different. Okay, so if you're an individual and you're a Canadian citizen or a permanent resident, you're excluded unless you're holding the property in trust or you're holding it as part of a partnership. Obviously, if you're holding it in a corporation, you're not an individual. Okay, so anybody that holds property in a corporation, you have to file. Yeah.
I mean, this sounds like an effort in data collection more than it is a tax.
100%. And so this actually, so it doesn't fall under the Income Tax Act. It falls under the Excise Tax Act, which deals with like sales tax, HST.
What?
So it's not even falling under the Income Tax Act. And you're absolutely right. And as I said at the start, we didn't think this was going to apply to people who, Canadian citizens, Canadian permanent residents that held real estate. But as it turns out, it does. But for all of those people, it's extremely unlikely that there's going to be any tax payable. So you're absolutely right, Paul. It's CRA essentially getting more information. Now, what they're going to use that information for, I don't know. But because they put such high penalties on it, they're really forcing people to provide information that potentially previously wasn't available. And there's another filing requirement that's coming into place at the end of this year that relates to trusts. And again, that's going to capture joint ventures and any other form of just beneficial trust. And it is, again, it's just data. It's just information. There's no income tax consequence of it. There's no HST or sales tax consequence of it. It's just data. So absolutely, Paul makes a really good point. It's unlikely that probably anybody on this call is actually going to be subject to the tax, but you're still going to have to provide all this information to CRA that was never previously provided. What they're going to do with it, I don't know, but it is more of an exercise in data collection than anything else.
I don't foresee that being anything good they're going to do with it.
I absolutely agree. Yeah, and the fact there's a lot of conspiracy theories out there. The fact that they set it to be April 30th as the filing deadline, so that accountants can't necessarily really get involved to say, yeah, you don't need to file, or yes, you do need to file. So there's again, how much of it is true, I don't know, but there's a lot of conspiracy theories out there about it. So excluded owner. If you're an excluded owner, you do not need to file a return. Essentially, you don't need to do anything with the UHT. Okay. If you are not an excluded owner, so essentially you're not an individual who is a Canadian citizen or permanent resident who holds real estate outside of a trust or a partnership, if you don't meet the exclusion, you have to file a return. Okay. So this catches anybody that's in a joint venture, anybody that owns property in a partnership, anybody that owns property in a corporation, anybody that owns property in a trust. Okay. So it's very, very broad. So if you are not an excluded owner, CRA has come up with this term. There's calling anybody that's not excluded an affected owner. So if you're an affected owner, you have to file a return. You may or may not be subject to the tax. So an affected owner is anyone who, a Canadian citizen or permanent resident who owns property as a trustee of a trust, permanent resident who owns residential property as a partner in a partnership. If you own property in a corporation, because I'm going to assume that nobody on here owns a public corporation that owns real estate. It might be a real estate or a real estate investment trust that you own that's actually a public company. That it does not have to file, and you do not have to file if you own units in that. But if you own your own corporation in Canada, you have to file. And then obviously the one point in here that we thought was going to be the only point, if you're an individual who's not a Canadian citizen or permanent resident, you have to file. And so a corporation that is incorporated outside of Canada that owns Canadian real estate would also have to file. So you have to file a separate UHT return for every property. So even if it's a single corporation owns 5 properties, it's 5 UHT returns. It's not just one for the corporation, it's UHT return per property, okay? It's based off of the properties that are owned at December 31st. So if we're in a corporation, it doesn't matter what year end of the corporation, it doesn't matter what the year end of the corporation is, it's based off of calendar year. So it's what's owned at December 31st, 2022. The return related to that property must be filed before April 30th, 2023. Okay, so it doesn't matter what your corporate year end is. And then if the tax applies, it would also be payable before April 30th as well. So an affected owner has to file a return. And then there's a bunch of exceptions that you may or may not meet that's going to get you out of actually having to pay the tax. So this first point on here is very important. The UHT Act, unlike some of our other tax rules, it is based entirely on legal ownership. In this case, being title. So the person or entity that must file the UHT return is the individual or entity that is on title. Okay, so I deal with a lot of people who buy properties personally, and then they use some sort of a trust arrangement to put that property into a corporation so that the corporation essentially is the beneficial owner. In that case, the individual would have to file because they're an individual that are holding the property in trust. And so but the individual has to file because they're the one that's on title. It's not the corporation that's filing because it's the beneficial owner, it's the legal owner, it's the person that's on title that has to file the UHT return, okay? Very important. That's actually the #1 question that we've been getting is who has to file the return. People are realizing that they have to file, but they don't actually know who has to file. So the person on title or the entity that's on title, that is who is required to file the form. In Ontario, that's based on whoever's registered in the land registry system. It could be different depending on the province, but in Ontario, it's based on land registry. And so, as I said, this is different than our general tax rules that look at beneficial ownership. UHT only looks at legal ownership. So who's on title? If there's multiple people on title, all of them have to file. If there's multiple entities on title, all of them have to file, okay? So there's 3 categories of exemptions: by owner, by property type, and by sort of usage. This one, so anybody that actually holds title in a corporation, you're going to be exempt, likely under this criteria, a specified Canadian corporation. If you hold property under trust, like a joint venture, you potentially will be eligible for the exemption, a trustee of a specified Canadian trust. So the first 3 points, a specified Canadian corporation, a specified Canadian partnership, a specified Canadian trust, those are going to get 95% of people out of having to pay the tax. Essentially what a specified Canadian corporation is is a corporation that is owned by Canadian citizens or permanent residents. So essentially, if you have less than 10% foreign ownership in a corporation that holds real estate, it has to file, but it won't be subject to the tax because it's a specified Canadian corporation. And the same is true for the partnership and the trust. A specified Canadian trust is a trust that only has as beneficiaries of the trust Canadian citizens or permanent residents, or corporations set up in Canada. So as long as there's no foreign ownership or less than 10% foreign ownership, this exemption is going to get most people who are just investing in real estate in Canada as Canadian citizens or Canadian permanent residents. This is going to get most of them out of having to pay the tax. Okay. There are lots of other exemptions, but these three, for the most part, I think every single UHT question about someone asking about whether they had to file or not, in most cases, the answer was yes, you have to file, but you're going to be exempt for one of these three reasons. Okay. There's lots of others. If you're a new owner in a calendar year, you still have to file the return, but you're exempt. So you're not going to be subject to the tax. If you're the executor of an estate for someone who's passed away, they also don't have to file a tax or they don't have to pay the tax. They would still have to file the return. So this is based on the availability of the property. So if it's newly constructed, you still have to file the return, but you're not subject to the tax. If it's not suitable to live in year round, so essentially if you can't get to it, it's, you know, up north and, you know, with the snow, you can't get to it, then you still have to file the return, but you would be able to essentially claim the exemption. If it's uninhabitable for a certain number of days because there's been some sort of disaster, or if the property is under significant renovation and cannot be lived in, you're going to be exempt from the tax, but you still have to file the return. Okay. Based on location and use. So if you have vacation property that is owned through, again, corporation, trust, partnership, then you would potentially have to file the return, but you wouldn't be subject to the tax, assuming that it's in an eligible location. Now, this does not capture people's cottages. So let's say you're an individual and you own a cottage. Because you're an individual and you own it personally, it's not in a corporation or trust or partnership, you're an excluded owner. You don't have to file the return. Okay. So I get a lot of questions when people hear this and they're like, I have to file a return because I own a cottage. No. If you own it personally and you don't rent it and you don't do anything with it, you use it personally, you're an excluded owner. You don't have to do anything with it. If you do rent it and you report that rental income personally, you're still an excluded owner. You own it, you report it, you're still excluded, you don't have to file a return. If you have a cottage that is owned by a trust, so let's say it was your parents' cottage, they deceased, it went to their estate, an estate is a trust, and the cottage is still owned by the trust, now you have to file because it's owned by a trust. Okay, so there can be circumstances where you would have to file, but if you own it, it's your cottage, whether you rent it or not. If it's rented and you report it personally, or it's not rented, you're excluded. Okay. Exemptions based on the occupant. So this is essentially, you have a property that's an investment property, but it's fully rented. You're going to essentially be exempt. Now there's different rules. So it depends on whether the person that's renting is non-arm's length or arm's length. And there's certain periods of time that has to be rented. As I said, in conversations that I've had with CRA, they essentially say, use the easiest exemption. Okay, so let's say we have a property that's owned by a corporation. I'm exempt, assuming that I have no foreign ownership in that corporation. So I can use the specified corporation exemption rather than trying to use one based on an occupant, where now I have to say, well, yes, they lived there for 180 days and I have to have a lease and I have to use the easier exemption, being it's owned by a corporation that has no foreign ownership. I'm exempt. Okay. If you have to get down to occupants or location or anything like that, it's harder to support the exemption. Okay. But they are there. So if you don't meet some of the broader ones, these other ones will potentially exempt you from having to pay the tax. So again, qualified occupancy, you have to have at least 1 month in a calendar year. Arm's length, you have to have a written contract if it's non-arm's length. So there are some different rules depending on whether you're arm's length or non-arm's length. Okay, so You do have to pay attention to, whether you're paying market rent, if it's non-arm's length and things like that. But as I said, if you meet one of the higher level exemptions, use those. Don't worry about trying to figure out a qualifying occupancy period. So specific information needed to complete the return. So you need to know what the type of the property is. Is it a detached home? Is it a townhouse? Is it a duplex? Is it a condominium? So you have to know what it is. It's just a checkbox. Again, if you Google underused housing tax return, it's called a UHT. I want to say 2900. It shows you exactly what the things you need to know. But essentially, you need to know what kind of property is. You need to have the year it was purchased, the type of ownership. So is it sole, joint tenancy, or tenants in common? Okay. In my example of a corporation, if the corporation is the only one on title, sole ownership, 100%. If we've got co-owners, so let's say we have spouses that own the property, but it's also being held in trust. So now they have to file a return, but that would potentially be an example of joint tenancy. And then tenants in common is more or less the same thing. From an accounting perspective, from a legal, it's different, but tenants in common is sort of the same as joint tenancy from an accounting perspective. So you need to know what kind of ownership the property is under. And then you have to assign the ownership percentage. So, is it 50-50? Is it 60-40? What's that ownership percentage? You need to know the assessed value. So the assessed value is essentially what's on your property tax statement for 2022 or 2023. We've kind of used them interchangeably. But if there's a real big difference, use the 2022. But essentially, your 2022 property tax statement is going to have your assessed value. And then your most recent sale price, which is essentially, in a lot of cases, has been, at least what we've seen, it's what you bought the property for. So hopefully, if it's an older property that you had for a long time, you have that information. And then finally, you need your property ID and your property tax roll number. Again, property tax roll number, it's on your property tax statement. The property ID is a 9-digit number that is on, it will be on your purchase documents. So essentially the documents that show the transfer of title, it's on those documents. There's actually an Ontario website that you can actually get the property ID from as well if you don't happen to have it. It may be on the property tax statement, I don't remember. But that is essentially the bulk of the information that you need to complete the form. Okay, there's not a lot here. It's not a complicated form. It's just address, name of owner, this information, and then you pick your exemption. That's essentially the form. Okay. So the last couple slides here are just common scenarios. These are questions, the sort of the more common questions that we get. Canadian private corporations are affected owners. So we get a lot. I own a corporation. Do I have to file? Yes. Canadian private corporation is an affected owner. It will need to file a return, but as long as there's no foreign ownership in the corporation, it's going to be a specified Canadian corp. It's going to be exempt from paying the tax. If you are in a partnership, each partner of the partnership has to file a return. So even if you're not on title, if you're holding the property as a partner in a partnership, every partner has to file a return. Okay, even though they might not be on title. Each of the other ones, it's only the person on title. The partnership, for whatever reason, they have specified if you're in a partnership, each partner in the partnership has to file a return.
But what's a partnership then?
Good question. So most people that own through a partnership know it's a partnership. Okay, and so for purposes of this, a joint venture is not a partnership.
Yeah,
a joint venture is a trust. So it still has to file, but it's not a partnership. So with a joint venture, if you're in a joint venture, it's the person that's party to the joint venture that is on title. They have to file the return.
So I guess partnership would be like tenants in common or joint tenancies.
A partnership is a real is an actual thing. So if you file your personal return and you're filing properties on your personal return, there's actually a checkbox that says I'm a co-owner or I'm a partner in a partnership. So if you've selected partner in a partnership, you are potentially a partnership, even though you might not have meant to do that.
I don't think CRA knows what a partnership is.
That's fair enough. And so a partnership and a joint venture are very, very close to being the same thing. But essentially a joint venture we call a joint venture, and a partnership we call a partnership. They are two very, very different things in the eyes of tax, but they are more or less exactly the same. So that's why if you're in a joint venture, your joint venture agreement should not say we are joint venture partners, because now CRA could say that that joint venture agreement is actually a partnership agreement, and they could call you a partnership instead of a joint venture. So that's the wording of a joint venture. It's that simple as the wrong wording in a joint venture agreement can make you a partnership. So Paul, to answer your question, there lots of things can be a partnership without even intending for them to be a partnership. But we always try to say they're a joint venture so that we can avoid the partnership rules.
Okay.
Canadian citizens or permanent residents holding property as co-owners should be excluded. So we get a lot of questions of, you know, I own a property with my spouse. We report it personally. We rent it, but we report it personally. Are we considered a partnership, or do we have a joint venture? If you're both on title, we're just saying that's co-owners. Both individuals are Canadian citizens or permanent residents. They're both excluded owners. Nobody would have to file. Okay. So a co-owning a property with someone else does not automatically create a partnership or a joint venture for that matter. And then I mentioned this already, but a trustee of a trust is generally the affected owner. So the person that actually holds title, they are considered the trustee in a bare trust. They're the ones that have to file the return. So that, at a very high level and relatively quickly, is the underused housing tax. So as I said, very important, determine if you have to file. If you have to file, file, because the penalties for not filing are huge.
Yeah, that's obvious. Well, thanks for that. Now let's get through a few questions. I imagine there's going to be some questions here. We'll send a few questions Andrew's way, and then we'll let him get back to work there. So, I mean, I guess pump it through the chat, and if you want, I'll read it out, or just unmute yourself. I promise I won't judge you what you're wearing or anything, but unmute yourself if you want. Give us a question.
Can I talk? Sorry.
Yes, Bart.
So I have listened to many accountants so far, and the thing we're getting stuck on is my husband and I own some properties together. We have our principal residence plus other properties. Some we rent, some family members in, whatever. Are we a partnership?
So both of you are on title?
We have 6 properties. I think 3 of them were both on titles. The other ones were individually on them, so we're unaffected. But
okay, so the ones where you're both on title, do you both report if they're a rental?
we report one of them. Yes, that's a rental.
Okay, so the reason I asked is, so if two, so let's say, so the 3 that are owned jointly, one's your principal, the other one you don't rent, and you just, let's call it a cottage, and then the third you rent, but both of you report the rental. More or less correct? Okay. So yes, on all 3 of those, you're excluded. You do not have to file a return.
And we own, okay, so we own other ones together. We own 6 properties. So we own another one together, but we don't rent it. It's our family members live in it. Are we, so we're excluded?
But the 2 of you own it, and you just choose to provide family member. No rent.
So we don't have to do anything. Okay. All right.
Good there.
Thank
you. Where you potentially would have an issue is, let's say you own the property 100%. You're the only person on title.
Yes.
But you report that property with your spouse. Now we have a trust, right? Because you hold the property, you're the only one on title, but someone other than you is reporting the rental income. So you're still reporting some, let's call it a 50-50 split. You're reporting 50%, but you're 100% on title. The other person is reporting 50%, but they're not on title at all. That, in that scenario, we have a trust.
Okay.
So you would have to file a return in that scenario.
Got it. Thank you. Clear, finally. Thank you.
Perfect.
Lucky girl, Barb. All right. Here's a good one. What about private lending, first mortgage, if their names are on title?
So we've got a scenario where somebody's lent to just, so they're not on, so they're not involved in the actual reporting of the rental,
No.
but they've provided a first mortgage or a second mortgage, and for that, they've registered against the title.
Yes. Yeah.
That is the first time someone has asked that question.
That's a good one.
That is a good one. I mean, I would say if they're on title and they're not reporting the property, we have a trust. They're holding title to that property for the benefit of someone else. I think we have a trust. I think potentially there is a reporting requirement there.
I mean, I'm no accountant, but if it's so gray like that, I'm thinking just do it. Why risk 10 G's, right?
And so that's so Paul makes a really good point, and that's essentially the approach that we have taken is if you're on the fence, if you don't know, there's no downside to filing other than potentially you're providing information to CRA that they don't otherwise have. But other than that downside, to avoid a potential $5,000 penalty for an individual, if you think you might have a filing requirement, file. As I said, the information that's on the form, they're pretty easy to fill out. They're pretty quick. To avoid a $5,000 penalty, or if you've got 5 properties, a $25,000 penalty, I say file the form.
Yeah.
Hi, it's Tammy Sharp here. When you're doing private lending, you're registered against the title you register a charge. You're not an owner.
Right. Yeah.
So that's not, otherwise every bank on title who's ever had a mortgage registered would have to declare, which doesn't make sense. So
For sure. Yeah.
I would say that.
Yeah. So Tammy makes a good point. If you're a creditor and you're registered against title, that's different than being on title.
That's right.
Yeah, maybe the wording is a little bit off here, but yeah, that also makes sense.
Because
Okay.
I do private lending and second mortgages first, and you just have a charge registered against the title. You're not on the title as the owner.
Yeah.
Yeah.
Right.
So that is what Tammy's talking about is very different than what we were just talking about, where you're actually on title. Registering as a creditor against title, very, very different. You don't own the property. You just have a claim against it.
I guess if you're a lender, you would only be on title, Tammy, if you had to go through a power of sale or something.
Yeah, I mean, at that point, if title somehow gets transferred to you due to foreclosure or something, but I think that's rare.
Yeah. Okay, we're splitting hairs. Anyway, thanks for that. Okay.
Hello, hi, this is Gordon.
Okay, go ahead.
Just to follow up on that foreclosure question. So let's say somebody owned it as of December 31st, and it's a VTB, vendor take back, and they failed, and the the lender goes after them and gets the house on March. And the previous owner did not file the UHT. So who's liable for the tax?
Whoever owned it at December 31st.
Sorry, so the previous owner as of December 31st is still liable for reporting in that $10,000 penalty.
That's as I understand it, whoever is the individual or entity on title at December 31st, 2022, they are the one that has the reporting obligation.
Yeah, that makes sense.
Thank you.
Okay.
Hi.
Go ahead, Bailey.
Hi, guys. We have a question regarding the multifamily. So from the CRA website, it looks like if a property over 4 units, you don't need to file the claim. Is that true or not?
That is true. So the UHT Act only deals with their definition for the purposes of the UHT Act is that a residential property is one that is equal to or less than 3 units. So if you have a legal 4-plex or above, you are not subject to the UHT Act.
Great, thank you. And the previous question regarding like who fill the form. So if the personal name is on the title by 2022, so we need to use a personal individual to fill the form, not the holding company. Is that correct? Just verify.
That's correct, yes. So if and I see it a lot where individuals are actually on title, but then they use a trust arrangement to provide beneficial ownership to a corporation or some other entity. In that case, it's the person that's on, or it's the individual or entity that's on title. So always when the UHT Act uses owner, they mean entity on title. So whoever is on title has the obligation to file the return.
Thank you so much. So that's, I got stopped today, actually. The last one, sorry, just like for the, you see, like we have the holding company, but we use a trust agreement. We did like the tricky ways of when we purchase the closing day, we have 2 lawyers to take care of it. One is we do the mortgage, another one we do the trust agreement to link the property to the holding company. We do like claim the tax every year through the corporation. So for this case, we still need to file it, right?
That's correct, because essentially you've created a trust by doing that. You as the individual are holding the property in trust for the corporation. So we essentially have a trust arrangement. You would not be an excluded owner, you would be an affected owner. You would have to file a return.
Okay, got it. Thank you so much.
Thank you, sir.
Just a follow-up on the multifamilies. If the multifamily is owned under a corporation, are we then still obligated to file the return?
So you're saying if the property is greater than 4 or greater than 3 units and it's owned by a corporation? No, you do not have to file the form. Essentially, once the property has more than 3 legal units, it is not subject to the UHT Act. Whether it's owned by a corporation, a trust, an individual, that doesn't matter in this case. It's excluded because it's greater than 3 units.
Perfect. Okay,
Hi,
great.
can I ask a question?
Go ahead, Christine.
So it's in regards to the trust where the individual is holding the property in trust for the corporation. I understand the individual has to file because they are the trustee. Does the corporation also has to file?
No. So the only in a partnership, each of the partners has to file. In any other form, only the individual on title or only the entity on title has to file.
Okay, perfect. Thank you.
Hey, Tom, did you have a question?
Yeah, so 3 quick scenarios. So I own a property that's just in my name and I rent it out. So I don't have to file, correct?
You're an excluded owner. If you own it and you report it personally, you're an excluded owner. Yes.
Right. And then I think it's tied back to the last one. I own a property and I have a JV. They collect, like they get ownership on the CRA. So it's like a 50-50, but I'm on title. So I'm the one who reports, not them, correct?
That's correct.
And when they're on title and I get the benefit, they have to report, not me.
That's correct. So anybody, the individual or entity on title is the one that has to report. So if you have a joint venture and only one of the parties is on title, they're the ones that have to report. The other party or parties to the joint venture do not have to file a return because they're not on title.
Great. Thanks, Paul. Thanks, Andrew.
Someone's gonna make a flow chart here.
We actually have one, but it's
who else had one? Gordon, another question?
Yeah, so I'm sure there's lots of families that own multiple houses directly, personally, and presuming they're all Canadian citizens. So the husband and spouse has a principal residence. They also own other directly on name on title. And also maybe the mother and the child owns another house and so on. But they're all Canadian citizens. So do any of these combinations require the individuals to file under this scenario?
That was a lot of people and owners, so it would, it would depend. If we, again, if you have an individual owns a property and they live in it, they're excluded. If an individual owns a property, but they hold it in trust for someone else to live in, potentially you have to file.
Presumably, they're all rental, right? So they're all third-party, legitimate third-party arm's length renters, right? So they don't live, there's no family members, but they do own it and also earn income. So does that still allow them to be excluded?
So it's not the earning of the income that makes them excluded or not. It's the ownership. So if I have an individual, so I own a property, but I essentially, me and someone else, one of my siblings, we report it together, but I'm the only one on title. I've now created a joint venture. Whether I intended to or not, I've created a joint venture because I have legal ownership, but my sibling is actually reporting a part of that, essentially a part of the ownership of that property, but I'm the only one that's on title. I've created a joint venture, I've created a trust, I've created a filing obligation.
Okay.
So it's not based on whether the property is used to earn income or not. It's based on who owns it and who's actually reporting or who's using it, and whether I've created a trust or a partnership by doing that.
So if you were to push this to the extreme where one person owns 10 houses and they're the only person on title through 10 houses, then they are excluded.
If an individual owns 10 houses,
yes,
and they're either empty or they're rented, and if they're rented, that individual is the only one that's reporting the rental of those 10 properties, then they're excluded, assuming that individual is a Canadian citizen or permanent resident. But if I have 10 properties all owned by an individual, but that individual and another individual actually report the rental of those properties, now I've got a joint venture, the owner has to file.
Right. Okay, thank you.
Got it.
So it's regarding the same question, rental. So if myself and my spouse, my wife.
Praveen, we can't hear you, buddy.
So can you hear me now?
Yeah, you got to speak right into the speaker and try and speak.
Yeah, sorry. Yeah, is it clear?
Sort of. Try your best.
Okay. So I'm just trying to understand the question that recently had. So if myself and my spouse both are on the title for rental property, and if we are reporting, if one of us is reporting the rental income, then do we need to report it? Do we need to file it?
So I'm having a hard time hearing you, but I think you said that you and your spouse are on title, and then and you report the property, like the two of you together report the property personally.
Yes.
Yeah.
So one of us report the rental income.
So one of you reports the rental income, but you both own it.
Yeah.
Okay. So then you would, in that scenario, the one that's not reporting the income would have to file. So this is actually a good example of one of the reasons that we think CRA is doing this, is depending on the circumstances could be very, very different, but in certain circumstances, we want to report a property in a situation like this. So both spouses are on title to get essentially a good rate on a mortgage or to get the mortgage. But one of the spouses makes considerably more than the other spouse. So we put it on the lower income spouse to avoid the tax consequences that would come with putting it on the higher income spouse. In the past, CRA wouldn't know what the ownership of that property was. So they wouldn't necessarily know that the other spouse was part owner, or that the individual reporting the property either had ownership or didn't have ownership. These new UHT rules and the UHT return now are going to tell CRA what the ownership of that property is. Okay, so in the scenario described, co-owners, spouses own the property together, both are on title, but only one of the spouses reports the rental income related to the property. Based on tax rules, it is likely that both spouses should be reporting the rental income. Now, there's lots of reasons that that might be different, but just in general terms, based on tax rules, both spouses would have to report the rental income from that property because it's jointly owned. Okay. As I said, there's lots of reasons why it might be one or the other, but in general, it would have to be both. It's being reported by one. As I said, in the past, CRA wouldn't necessarily know that. The requirement now, because we have a trust, we have ownership where I'm not reporting, someone else is reporting. So in my opinion, we have a trust. The non-reporting spouse now has to file a UHT return. That's essentially going to notify CRA of the way the property is being reported, which they wouldn't have been previously aware of. Okay, so this is one of the scenarios where we're giving CRA some information that they potentially didn't have before.
Thanks a lot.
That was a good one. Let's do a few more, and then we'll let Andrew get back to work. Anybody else?
Yeah, can I ask one more question?
Go ahead, Nisha.
So I have a corporation with a multifamily in there, which of course it's a multifamily, therefore it's exempt. But in that corporation, I also have other properties, which are, let's say, duplexes. So am I still required, the corporation is still required to file the return?
So I mentioned earlier, the return is by property, not by owner. So you may own in any entity, whether that be a corporation or an individual that owns multiple properties. If you have properties that are over 3 units, they would be excluded and wouldn't have to file a return. But if the same individual or the same entity, being a corporation, owns other properties that are not excluded, returns would have to be filed for those.
And so the returns are filed by the owners or by the corporation?
By whoever owns the property, whoever's on title.
Fair. So if a trustee is on the title, then the trustee is filing the return. And if a corporation is on the title, corporation is filing the return.
That's correct.
Great, thank you.
You got your work cut out for you, Sharmil.
Jeez, man, this is crazy.
Okay, let's do a couple more. Let me see what do we got in the chat here. So I think we answered this one. If I own several properties only under my name, not a corp, no JV partner, and you're filing, you're reporting the income, are you exempt? I think that's a yes, right?
Well, yes, but you mean excluded. So remember, there's exclusions and exemptions. So we just have to be clear on the terminology, but an excluded person does not have to file a return. An exempt person does not have to pay the tax, but they still have to file a return.
Yes. Okay.
So in that scenario, it sounds like they own it, they report it. No JV, no partnership, no nothing, just simple, they own it, they report it. That, as from what I understand, that is an excluded owner. There would be no filing requirement.
Good. Yeah, we talked about multifamily, talked about the JV. Okay, I mean, I think so we're probably a corporation and it's rented, the rent is reported, that's also a no. What? If I have a property in a corporation and it's rented, the rent is reported, you are exempt or excluded?
You're going to be exempt, assuming that the corporation is Canadian owned, but you're not going to be excluded. So as soon as you have a property that is owned in trust, in a partnership, or in a corporation, you're not an excluded owner. You're going to have to file a return.
You have to file, but probably
probably going to be exempt from the tax. So as soon as you own a property in a corporation, you got to file because you're not an excluded owner. So even if the property that's in the corporation isn't rented, you still have to file because you don't meet the exemption, or sorry, you don't meet the exclusion to get you out of having to file the return.
Yeah, and if you have a Canadian passport or a PR card, then but you're exempt from the tax, basically.
That's right. As long as you, yeah, as long as you're a permanent resident or a Canadian citizen, you're going to be exempt from the tax, but you still have to file the return.
If I own a property with my adult child, both on title, and you both report the income on T776 form, do you have to file the UHT?
No, you're excluded.
Excluded. Yeah.
So essentially anybody that owns it and reports it. So if you've got me on title and I report it, I'm fine, I'm excluded. If we've got me and my spouse on title, we both report it, we're excluded. If we've got me and my sibling on both on title, both report it, we're excluded. So again, as if we have individual ownership and the individuals that are on title report and no one else, you're excluded. As soon as you have anyone else reporting, someone on title that doesn't report, we end up with some form of trust or partnership. Now somebody has to report.
It just sounds like they want to know everybody who's involved in the deal.
And I think that's, at the end of the day, that's what it's going to come down to. Is there's been a lot of joint ventures, partnerships, whatever you want to call them, that have been used for real estate ownership over the last 3 years. And certainly much longer than that, but especially over the last 3 years, because everyone wanted to get into the real estate game and you couldn't necessarily get the mortgage. Joint ventures are a perfect way around that. I can get somebody else on the mortgage, but I get the benefit of ownership. I just have to give up some percentage to do that.
Yeah.
So joint ventures became a really popular way to get access to additional credit by using other people's borrowing capacity.
Yeah.
But a lot of that has not been reported correctly. You know, people that are actually in a joint venture that are supposed to be reporting 50% of the property don't report anything, because their understanding is that the person on title actually has to report. That's not the way a joint venture works for tax purposes. So there's been a lot of that happening. Now, again, this particular legislation was originally billed as, it was intended to reduce foreign owners parking their wealth in Canadian real estate, but not actually going through the hassle of renting. So essentially they buy up Canadian real estate, they just leave it empty because they're just using it as a storage of wealth. That's what this was described as addressing, was essentially all these empty properties. Everyone's looking for a place to live, but we've got all these properties that nobody's renting because they're just storing wealth in them. That's what they said they were, the point of this legislation was. I don't think that's the case, but
yeah.
that's
What they say and what their real intentions are often two different things.
Yeah, so I think I think it's more to get as much information as they can. One thing I didn't mention, and I always forget to mention this, if you own through a corporation, and this is one of those things that is just an added bonus to the whole silliness of this thing. If you own through a corporation, so title is held through a corporation, the corporation actually has to register for a special program account. So when you set up a corporation, you're given a business number. It's a 9-digit business number. Depending on what program accounts you have in your corporation, that business number has different endings. So the first number you get is an RC0001. If you have an HST account, it's an RT number. If you have payroll, it's RP. Any corporation that owns real estate has to register for an RU account. I don't know why they made it that you had to do this, but they have. So essentially you have to register your corporation for an RU program account, and then that RU number is what goes on the UHT return. The easiest way to do that right now, if you Google business registration online, CRA has this business registration online. You log in, you verify yourself that you are the business owner, and within 5 minutes you can get your RU number. That's the easiest way to do it. You can call CRA, but at this time of year, wait times can be long. Corporate, not normally so bad, but just given all the UHT stuff this year and a lot of sort of misinformation and misunderstanding, they're pretty busy as well. So business registration online is the easiest way to get an RU number if you already have a corporation.
Well, y'all got some work to do.
As I said, if you think you have to file. Avoid the $5,000 penalty.
Okay. So if Andrew, there's going to be a lot of people listening to this. I mean, if they need help with their taxes sometime, in the near future or next year or whatever, how do they get a hold of you? And, I'm assuming your firm works with real estate investors. That's why you're here, right?
So we work mostly, we certainly would be our specialty is working with real estate investors. I will say we are not taking any additional clients for the 2022 personal tax year. We only have about 5 weeks left before the end of April, maybe 5.5. With our current client load and the UHT debacle, we won't be taking on personal tax clients for 2022. But certainly after the end of April, if you have, or for the 2023 tax year, if you need assistance, we can certainly help out there, but just not with respect to 2022.
Yeah, that's fair. I think a lot of people are in that boat, but we'll share your office information, and we'll let people know that, if you need help, coming, beyond April for next year and need some counsel. I think that's important because, I always want my accountant to be available to talk to and give me advice. I know you guys have, a million people shuffling papers and doing all the returns and stuff like that, and that's fine. But I need the stuff that's in there. So
yeah, and I mean that's what I like about accounting. I mean, doing tax returns and stuff, it's a sort of a necessary evil. It has to be done, but it's certainly not the interesting part. We are sort of more about, let's understand what's going on and let's put the right solution in place, as opposed to just filing tax returns. But having said that, we don't really do a whole lot of that in the first 5 months of the year because it takes too much time to file the bulk of the compliance returns that are due within the first 5 months of the year.
got it. Okay, Andrew, I mean, I appreciate it. I think everybody else appreciates your time here. Thanks for doing this. I think you helped a lot of us here. Again, we'll share your contact info, and hopefully we'll do another session soon.
Sounds good.
Okay, everyone. I'm just
Thanks,
gonna take care, Andrew. I'm gonna give you a little closing message. So if most of you missed my little opening message there, I just wanted to say that the last year and a half obviously has been interesting, to say the least, with the real estate market. We all know things are up and down and sideways and stuff like that. And, a lot of people are sitting on their hands and not doing anything, which is normal. We're humans. I mean, confused minds always say no. But, I've had to pivot my own portfolio and how I do things. And I think it's important for people to kind of look at their own portfolios and do that themselves also, because in the end, you're the one who's responsible. You're the asset manager in your portfolio, and I'm not responsible. I can help you, but you got to know what's going on. If you have cash sitting on the sidelines, you're kind of stuck between a rock and a hard place. I mean, we want to have cash on the sidelines in times like this because expenses are going up. For some people, income's going down at the same time. So you definitely need cash. And I'm not saying to spend all your cash or something, but if you have cash and you're relatively comfortable, you're getting destroyed by inflation. And it sucks. They call it the invisible tax for a reason. You don't know what's happening until you go to the grocery store and peppers are $11 a pound. And when real estate prices come back, you're going to be surprised how fast they go back up. I mean, everyone's always surprised, but I'm like, why are you surprised? Like, look what's happening. Anyone see the article that came out yesterday? I made a YouTube video saying CIBC said 985,000 people came to Canada in 2022. And I guess I was wrong. It was more like 1,025,000. So, once rates come back down to a relative, comfortable level, we think it's 4.5. 4.5 sparks the market back up. Fixed rates, forget about overnight rates. Fixed rates back to 4.5, market comes back. 3.99 The day you see 3.99 advertised, watch out. It's going to go absolutely batshit crazy again. That's our prediction, and this is recorded. So, that's how strong we believe it. There's so much pent up demand with buyers who can't do anything. But my real point is that if you have the capacity, do something. There are many deals out there that are below market value that you can get and hold on. If you can make a little bit of cash flow, or even break even, you're paying 100, 200,000, 300,000, depending on the type of property, less than you would a couple of years ago. And we know those gains are going to come back. So it's important to be out there. And, one of our developments that we're currently doing, we were raising capital for that. And it was really popular because people didn't have an active place to go put their cash. Hey, I can go buy a triplex, or can I partner in development? But if you can't get qualified for anything, seeking partnerships and putting your money to work in a different way is still a very valuable exercise. Okay, it has to get put to work, or your money's lazy, it dies with inflation, right? It wants to work. So, and if you really don't have a lot of cash and you can't get financing, that's fine too. Again, I'm not judging anyone, but look at your own portfolio. And with all the properties we have, and I'm going to pick on Charmille because I know he has some multifamily properties and some of the tenants are not paying enough rent, and they've been there for maybe too long. This is a great opportunity when we're not in the acquisition phase as much as we were in the past, to look at some of these units and figure out, okay, how do I, get this property operating at its highest potential? Because that's a very, very valuable exercise. Okay. And we've had others go through the process of refinancing, accessing equity. I mean, there are investors that I worked with who bought properties in 2012, 13, 14, 15, and we're having conversations and retouching, and they have $700,000, $800,000, $1 million in equity in their property, and I'm like, oh my god, we've got to do something with this, because it's at some point, as an asset manager with that much equity sitting in your property, your returns become inefficient. Yes, you're making returns. It's not a bad thing, but your returns become inefficient. And as an asset manager, you want to put that to the best use possible, right? And if you can take some of that equity and get yourself something that's way below market value, you're doing your portfolio a favor. You're making a move when there's blood on the street that, when things come back to normal, you're like, holy shit, that was a great move, right? That's what we want to hear. And this is not me not trying to be a salesman. I'll take my salesman hat off and fix my hair here, but I'm doing the same thing with some of my own money. We have to. So that's been my message to everybody, right? So for this year, I have about 9 spots left for people to kind of work with and to do some coaching and mentoring. So I'm going to share my kind of application link here, and I'll put it in an email to you guys also with the recording for this call. Where the hell is this thing now? There we go. So if you're interested in talking to me, and what I like to do with people, especially for the first time, or if we haven't talked in a few years, is go through a portfolio review. Like, come and see me, let's talk, hopefully in person as much as possible. But if we have to do over Zoom, that's fine too. I want to know what's going on in your portfolio, what you have going on, where the opportunities, so I can see where the opportunities are, where the opportunities are not, what we should leave, what we should do. And really take a look at your goals and what your portfolio is trying to accomplish, what you want to accomplish with your portfolio, and see how we can get there the fastest. Okay, that's really what I want to do. And if we want to work together afterward, that's fine. And if we don't, no problem. I'm happy to leave you with the best of what I have and set you off. Okay, I really do want to help as many people as possible. So I'll put this form and application link in the email anyway. So a lot of people on this call have already done this with me even a few times, so no stress there. You guys know how to get a hold of me, but for some new people, this is the best way, and I'll email this to you also. So that's it. I'm going to shut up now. Andrew's still there. Thank you, buddy, and thanks for everybody for being on the call. I hope it was valuable to you guys. Take care.
Thanks, Paul.
Have a good night. Ciao, ciao.